All right, traders, welcome to today's market recap. This is Christian from Hertz Trade Trade Group, and it is Tuesday, March 7th. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving any advice or recommendations. Please read the full risk disclaimer here. So, a couple quick themes of the day, but you could tell by the red on the screen on the left that once again, market moving to the downside. Powell's statements got this market to kind of pull to the downside, but yeah, I mean, that's the highlight of today, or what really is in the news this morning was that Powell saying that they're open to raising interest rates faster if they need to. So this did move the market quite a bit this morning. If you look at the Fed Fund futures, right, if this is where you can basically tell what the market is pricing in terms of what the Fed funds rate, which is what the Fed controls, what this is implying. And going into today, it was kind of steady at the implied rate of 30 basis points for the next meeting on March 22nd. That moved significantly today, so that moved by 10 basis points. So his words did move the markets. Now, again, coming into today, I thought he would be kind of, would say some of these things as being that they were going to continue to be data dependent, and if they needed to, they would do the 50 basis points. But I think, maybe a little bit more severe than what I was thinking, and the market did move to that. So I would say if you're looking for a silver lining for this, I would say two things: that the market, you could see the market real time, both in the Fed Fund futures and the price action in equities, price this in. So we are now closer to 50 basis points, and they should be able to do that for the next meeting if they need to. Without really shocking the market, because the market did adjust downward to this. We also, I think a lot of people are also looking at what that, I guess they call it terminal rate, is what the high point of the rate is. Some people are thinking that it goes higher than this. I mean, that's possible. It really will depend, I think, on what the data points that we're going to see. But right now it looks like the high point is 5.6, and again, that's been moving. That was around 5.45 and then 5.5. So things are moving. As the last data points that we got for inflation were higher than expected. So it is what it is. The road to getting inflation, and I think I'm stealing this from Powell too, is basically it's bumpy to get inflation to come lower, right? It's not going to be, as we have talked about previously in these videos, it's not going to be a straight line. It doesn't work that way. But we'll see. We've got the next report that comes out next week, and they're looking for, so it kind of brings us to, okay, if the Fed's going to be data dependent, what are we going to see in terms of Friday? Which we get the change in the first, it's usually the first Friday of the month, but it's the second because February was a shortened month. But we get the change in non-farm payrolls. They're looking for 224, but probably this of course, if the number is way different than what's expected here, the market will move. But really, I think what's going to be most important here is the average hourly earnings month over month, right? Because that is another gauge of inflation. They're looking for 0.3. So we'll see how that comes out. And then, of course, next week, this is going to be on the 14th, the CPI, and they are expecting 0.4, right, which is still a high number. My thought as I've been saying now for a couple months, is that these inflation numbers need to come, the month over month number needs to come in, definitely less than 0.3, more so like flat, right? And that will get the, if there are consecutive months of, less than 0.3%, then you get down to the Fed's target. But if you can't get under that, then the numbers are not going to meet what the Fed's target is, which is 2%. So 0.4, and think about how to interpret this as we get close. Now that the market is pricing in close to a 0.5 percentage point, if the number comes in light, what do you think the market's going to do? My guess is that the market's going to rally pretty decently. But if the number comes in line with 0.4 or worse, even comes in higher, then we've got more problems on our hands, and it just means that what the Fed is doing is not bringing down that number yet. So we'll see. I don't have any information out about whether I think the number is going to come in less. The way that they kind of put these numbers together, sometimes they make sense, sometimes they don't really make they don't really make sense. We are seeing some things come down a little bit, in terms of the commodity. You could look at the commodity prices and see what they're doing, but of course, labor and housing is a bigger component of that. So we'll just kind of have to wait and see. And but that is what is going to dictate, I think, what this market does, right? So again, I'll move on from that because I'm sure we'll talk more about that in the days leading up to CPI, because this is just, we're in a very macro environment right now, and it's really being driven, I think, by how many more rate hikes we're going to get, because that does reinforce liquidity. So the VIX was up 5% today. Amazing. It's still below 20. So again, it's still not pricing in major volatility. I don't want to get into this discussion about 0-day options. There's these arguments about whether that's suppressing the volatility. I don't agree with that. I think the VIX measures what it measures, 30-day implied volatility. It's not meant to measure what the intraday volatility is. So my thought too, it's because these things are getting so much attention that the people who are trading these, don't forget that if there was no 0-day expiration options, they would be trading weeklies or the bi-weekly options, right? It's just moving money over to something else. Now, of course, it can be a little bit more impactful because it's same day, but this is just taking, gambling money and putting it, instead of on the weeklies, it's putting it on, it's my expression from earlier was, it's just another roulette wheel on the casino floor. But it's not suppressing volatility. I know people are trying to make that case. The VIX is still under 20. Again, the VIX measures 30-day implied volatility of SPX options. I'll move on from there, but the VIX was up 5%, right? Even though it's still under 20, it still moved up 5% for the day. Some other developments in here too were, you're really getting this inverted yield curve. And again, this is not good for banks. So if you look at what the banks are doing, so you may ask yourself, why aren't, let me just bring up the right screen here so that you can see what yields are doing. We talk about yields almost every day. I know it's not the most exciting thing to talk about, but yes, the 2-year is above 5%. So, I purchased the 2-year bond the other day in Treasury Direct. I may buy more of it because I think that's pretty good to lock in, 5% for 2 years. And it's better than, the 10 and the 20-year, which, the 30-year bonds were actually up today. So you could see the yields really move, right? And that's, again, it's because it's moving with what, the possibility that the Fed is increasing that overnight rate. So that's big. That's big. 12 basis points versus the end of the curve. Yields are actually going the other way, down. So inverted yield curve, that's not good for banks. So if you look at what's going on with KRE and the regional bank ETF, you got to remember how a bank makes money, right? They are they're borrowing short term and they're lending long term is generally how a bank makes money, right? So if they're borrowing at a higher short term rate and lending it out at a lower rate, right, that's not good for their model. They make more money when the yield curve is is upward sloping, not inverted. So I know sometimes people think, oh, higher interest rates, that's good for banks. It depends what interest rate, right? And that's always the case whenever we're talking about interest rates, right? And you hear in the financial news about interest rates, what interest rate, right? Is it the overnight rate, which the Fed controls? Is it the 2-year? Is it the 10-year? Because all of these have different implications to them. But if you just hear interest rates, right? People sometimes don't get the understanding when you just hear the term interest rates without the maturity to it. All right, but you could see that's down 3. That was a big underperformer, and that's getting very close to those year lows for the regional bank ETF. XLF, which is a little bit different, because that also the XLF is not just banks, right? It's insurance companies too. That had a nasty day to it as well, but is decently off those October lows. Again, but completely different composition of what's in XLF versus the KRE regional bank ETF. All right, a few other points to make here, and then we'll wrap up today's video. Again, the breath has just been really nasty. It's been one of those situations where you just kind of have to wait for things. This is not updated for today, but somebody asked me on Twitter, what's my favorite breath indicator? This is one of them, the McClellan Summation Index. Again, I review this every other day, probably in these videos, but right, this is telling you that, again, that the wind is in your face as a stock picker. There's more names that are going down versus up. And we also measure that on the left of your screen. This is our own model, which uses down volume versus up volume, right, to give you a sense of what the pressure is, right, and how much the selling or buying pressure is. So that's continued to go down, and I think one of these economic data points, if they are better or not as bad as what everybody is fearing, then you might see a rally. If not, it's kind of more of the same for now. And again, you can't really predict when this is going to flip around, but it's telling us right now that we're continue to be in a bear crossover, and it's lasting a long time versus some of these upswings. So we just kind of have to wait for that. If you're playing things on the long side, you have to wait for buyers basically to come back in the market, right? They're not doing that. There's a huge MOC imbalance today, a big market on close imbalance today. So it just kind of shows there are people doing more selling, and probably taking advantage of the risk-free rate being so high, and allocating more and more money over to that area of the market. I wanted to review the indices really quick because I think there's a couple things to gather here, right? As I've been sending out on Twitter, as well as in the trading room, I've been talking, as well as I think in yesterday's video, price got rejected right at the bottom of value. So again, volume at price, so important in what I'm doing, because it gives such good levels. Notice yesterday we tried to rally inside the value area, and look at where we closed. We closed outside of it, and we're right back into testing the 200-day moving average, right? Very quickly. I think this also, like if you look at the cash index for S&P, I think this filled the gap today from what we saw on Friday's activity, right? So that's this, if you're a big gap person, or filling the gap type person. The 1 hour charts are also kind of revealing. That's why we look at these so closely. But we talked about this in the pre-market session. I said I was a little bit worried that and I drew this in the pre-market session today at 9 o'clock in the morning, saying, hey, if we break this, be careful, because that could mean a return to the top of value. Just to kind of go through our day and what we did, because I put out a midday video, and at that point we were down to the top of value. And I said, in my Sunday video, I talked about how, a move back might be a good buying opportunity, but we add up the price activity with what the market breadth is telling us, which I just thought looked too nasty for the day to do any dip buying. If we kind of came down here and the breadth was kind of neutral for the day, then I would say, okay, this might be a good buying opportunity, but the selling pressure was just too much, right? So we did break into value. That does create the 80% rule, because we started the period above value and we have entered into it. So there's an 80% chance for the rest of the week that we go down to 952, right? And get that bottom of value. So I would keep that in mind for tomorrow. Again, it's not a 100% rule, it's an 80% rule. If you're not familiar with that rule, or if you think I'm just making up, you could Google 80% rule using valuaries, or you could see my pinned tweet on Twitter, which will give you a little bit more explanation for it. All right, Qs did stop at the top of value. All right, so again, I have a similar one drawn for NASDAQ futures, right? Again, left shoulder head, right shoulder, there's a break of the neckline, and we are at the top of value, right? So there's a chance that that could hold. We also fell out of the value area. And again, I'll use Qs because I know more people look at the Qs than NASDAQ futures. But that's, so we basically stopped right there. So, you know, the Qs continue to show a little bit relative performance than at least they have this year, right? So if they could stop here at 296, you know, it says 42, which we're just a little bit under, but if we can hold in here, you know, then it might be constructive. But again, you know, we're going to need to see buyers come in, right, to kind of hold in here at that 295.75 level as well. All right, so I just wanted to provide a couple of those levels. Names that I'm watching, you know, I thought, you know, just a couple of names that reported after the close. CrowdStrike went up to this, you know, so again, here's an example of volume at price, right? Overhead supply, right? This virgin point of control, price getting right up to it, 135, and not able to overcome it. We'll see if that changes in the next couple of days. One name that saw a ton of option activity today was the C Limited. C Limited, same thing. You know, it took out this virgin point of control. It doesn't mean that it definitely has to revert back. We just are seeing that in a lot of places. You know, once you take out a virgin point of control, sometimes overhead supply does come into the picture. But look at the volume today, right? So buyers are going to have to come into this thing tomorrow to get this to stay over, excuse me, the $78 VPOC. With just a ton of option flow in this thing today on the call side, and opening too. I was surprised. All right, and then another name that reported today, which was Dick's Sporting Goods. Whoops, wrong symbol. You know, really nice breakout here. So I played, you know, I'm trying really to kind of back off trading when we're in a bearish, nicey crossover, as we have been. But I will do some scalping intraday. You know, I've been doing that with some of the leveraged ETFs. Again, they're day trades. And when I do start something, it's, you know, or when I do put on a position on, it's going to be a starter in this market, right? Until breadth improves. So I put on the starter in ASO. And then I also put on a starter in 4, and I'll explain that trade in just a second. But I like the, there's 15% short interest. Now, again, that's not, sometimes people look at the short interest and like their head explodes when they see big short interest. It still means that you have to get the shorts to cover, right? There has to be a reason for the shorts to cover. Sometimes just because so that a lot of times the shorts are right. So, you know, just make sure there's been so many wrong things being put out about short interest. So there has to be a reason for the shorts to want to go ahead, and I don't know why I'm having a difficult time here, but so as long as ASO, I would like to see ASO stay above 60. What I would like to see it get over is 61.33. Right, and maybe that could cause the shorts to, you know, if you get that nice buying activity, that might cause the shorts to, you know, cause them to cover a little bit, right? So that's why I kind of figured let's put on a starter position and we'll go from there. Foursquare was a name that had good earnings, right? I was not in it. I was watching, right, and waiting for a pullback. So, you know, very simple and defined, right? 66.84. That's something that I'll trade against. If it breaks into the value area, I'll abandon that trade. But you know, it's worth a shot. You know, I've been waiting for a pullback in this name, so you know, I got it, and you have a defined limit. Now, of course, you just have to kind of understand with this market, the poor breadth. We're in the bearish summation, McClellan summation index crossover. That if you are trading in this market and trying to swing trade, you're going to have some paper losses, not paper losses, the real losses, but you're going to have some paper cut losses, right, from time to time. For example, a couple of trades that I took off today, right? This was a name that we saw a lot of option activity, right? So PBF 46.50 out of this at 46.90. This was a trade that I did take a target in higher, right? But the last piece was a little bit of a loser from where I took the first target, right? STNG was one I put on yesterday. Right, this is another one. I bailed on this trade, and I bailed on it too early, by the way. It came back and it rebound. I talked about this midday, and I said, hey, I might actually look to put this thing back on. I didn't put it back on, but it did what I wanted to. So the analysis worked, right? It actually tested yesterday's lows, held, and bounced on this. All right, so those are a couple things on my radar. Again, I try to go very light, and while we're in this bearish crossover, and in really difficult environment with the Fed acting like they might raise interest rates 50 basis points rather than 25 for the 322 meeting. The name of the game is to kind of survive and advance and not give back profits where you made them, right? That's the whole key, right? And of course, like this last year, right, if you're doing well in this environment, congratulations. If you're struggling, you just kind of have to understand that this is not an awesome environment while the Fed is continuing to raise interest rates. And again, I think for the most part, a lot of traders want to see this come to an end, but you just kind of have to be patient and get through it and realize that there will be better days. But right now, this is not this is just not a great environment. So that's it for today's video. Have a great night. See you tomorrow.